Hey friends, welcome to today's Singapore Market Digest. I'm Iggy from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. Let's dive right into our first company of the day, United Overseas Bank, one of Singapore's banking giants. UOB recently released its 2024 annual report revealing some interesting details about executive compensation. The bank's chief executive officer, Wee Ee-chung, who also serves as deputy chairman, received a total package of $15 million for 2024. This breaks down to a salary of $1.44 million and a bonus of $13.56 million. What's notable here is that despite UOB reporting record net profits for the full year, Wee's compensation actually decreased by 5.5% compared to the $15.9 million he earned in 2023. UOB, trading under the ticker U11. SI on the Singapore Exchange saw its shares rise by $0.15 or 0.4% to close at $37.95 on Friday. This slight uptick suggests investors remain confident in the bank's performance despite the CEO's compensation adjustment. For those who might be new to UOB, it's one of Singapore's three major local banks alongside DBS and OCBC. Founded in 1935, UOB has grown into a leading bank in Asia, with a global network spanning 19 countries and territories. The bank offers a comprehensive range of financial services, including personal banking, business banking, private banking, asset management, and treasury services. Looking at UOB's recent performance, the bank has shown resilience in a challenging economic environment. Their record profits indicate strong fundamentals despite global economic uncertainties. The banking sector in Singapore has generally performed well, benefiting from rising interest rates that have boosted net interest margins. UOB's strong capital position also allows it to weather potential economic storms, while continuing to invest in digital transformation initiatives. From a technical analysis perspective, UOB shares have been trading in a relatively tight range over the past few months, suggesting a period of consolidation. The current price of $37.95 is near the upper end of this range, which could indicate potential resistance. However, the positive price action following the annual report release might signal a breakout to new highs if supported by sufficient trading volume. When comparing UOB to its peers, it's worth noting that all three major Singapore banks have reported strong results, but UOB's price-to-book ratio remains competitive, potentially offering value for investors looking for exposure to the Singapore banking sector. The bank's dividend yield also remains attractive for income-focused investors. Next up, let's talk about Singapore Airlines, our national carrier that's been soaring through some regulatory developments. SIA, trading under the ticker C6L. SI has received conditional approval from the Competition and Consumer Commission of Singapore, CCCS, for its proposed commercial cooperation with All Nippon Airways, ANA. This is significant news that could reshape competition on routes between Singapore and Japan. The two airlines first applied for this cooperation back in June 2021 and submitted an updated application in July 2023 after seeing signs of market recovery from the COVID-19 pandemic. The CCCS noted that both airlines have substantial market shares on direct flights between Singapore and Tokyo and have maintained a high combined market share in recent years. To address potential competition concerns, the airlines have made commitments to ensure they don't infringe on competition laws. Singapore Airlines shares closed flat at $6.80 on Friday, suggesting that investors are taking a wait-and-see approach to this development. The stock has been on a recovery path since the depths of the pandemic, reflecting the broader revival in global air travel. For those who might not be familiar with SIA, it's Singapore's flag carrier airline and one of the most respected airlines globally, known for its premium service quality. Founded in 1947, SIA operates a modern fleet of aircraft serving destinations across 6 continents. The airline is majority owned by Temasek Holdings, Singapore's state investment company. The partnership with ANA is part of SIA's broader strategy to strengthen its position in key markets through strategic alliances. This approach allows the airline to expand its network reach without the full capital expenditure of operating additional routes independently. The Japan-Singapore route is particularly important as Japan remains a popular destination for Singaporean travelers and a key business corridor. From a technical analysis standpoint, SIA shares have been trading in a range between 650 and 700 for several months. The stock appears to be consolidating after its post-pandemic recovery rally. The flat price action following this news suggests that the market had already priced in expectations of regulatory approval. In the broader aviation industry context, airlines worldwide are forming similar partnerships to optimize route networks and improve profitability. SCA's approach aligns with industry trends, though its premium positioning sets it apart from many competitors. The airline industry continues to face challenges including fuel price volatility and geopolitical tensions, but passenger demand has largely recovered to pre-pandemic levels on many routes. Moving on to our next company, let's shift gears to the electric vehicle space with NIO, a Chinese EV manufacturer that's listed on the Singapore Exchange. NIO, trading under the ticker NIO.SGX, released its fourth quarter financial results for the period ended December 31st, 2024, and the numbers tell an interesting story of growth mixed with financial challenges. Despite delivering a record number of vehicles during the quarter, NIO's net loss deepened to 7.1 billion yuan, approximately $1.3 billion. This represents a 27.5% increase in losses compared to the same period last year and a 38.7% wider loss than what was recorded in Q3. On a per-share basis, the loss was 3.45 yuan, worse than the 3.18 yuan loss in the same period the previous year. Despite these concerning figures, NIO maintains that its financial resources will be sufficient to support its operations in the ordinary course of business over the next 12 months. The market, however, reacted negatively to these results, with NIO shares on the Singapore Exchange falling $39 or 7.7% to close at $4.66 on Friday. For those who might not be familiar with NIO, it's one of China's leading premium electric vehicle manufacturers, often referred to as the Tesla of China. Founded in 2014, NIO has gained attention for its innovative battery swapping technology, which allows drivers to exchange depleted batteries for fully charged ones in just a few minutes, addressing one of the key concerns with electric vehicles: charging time. NIO's recent performance reflects the broader challenges facing the electric vehicle industry, particularly in China, where competition is intense. The company is investing heavily in research and development, expanding its product lineup, and building out its battery swapping network, all of which contribute to its current losses. However, these investments are aimed at securing a strong market position in the rapidly growing EV market. The record vehicle deliveries in Q4 show that demand for NIO's products remains strong, but the company needs to find a path to profitability to reassure investors. The EV market in China is becoming increasingly crowded, with both domestic and international players competing for market share, putting pressure on margins across the industry. From a technical analysis perspective, NIO shares have been in a downtrend for much of the past year, reflecting investor concerns about the company's path to profitability. The current price of $4.66 represents a significant discount from the stock's all-time highs, potentially offering value for investors who believe in the company's long-term prospects. However, the stock will likely remain volatile as the company works toward improving its financial performance. When comparing NIO to other EV manufacturers, it's worth noting that many companies in this space are experiencing similar challenges, balancing growth with profitability. Tesla, the industry leader, took years to achieve consistent profitability, suggesting that patience may be required for NIO investors. The company's premium positioning and technological innovations, particularly its battery swapping approach, provide differentiation in a crowded market. Let's round out today's digest with StarHill Global Real Estate Investment Trust, a Singapore-based REIT with a portfolio of retail and office properties across Asia, trading under the ticker P4DAU. StarHill Global REIT announced on Friday that it has secured a substantial $600 million loan from a club of banks, marking a significant financial development for the trust. This 5-year unsecured facility agreement consists of two main components: sustainability-linked term facilities of $300 million and sustainability-linked revolving credit facilities of another $300 million. The term facilities will be used to refinance the $100 million unsecured medium-term notes that are maturing in June, as well as the REIT's unsecured term loans in September ahead of their original maturities in 2026 and 2027. Meanwhile, the revolving credit facilities will provide flexibility for working capital requirements and general corporate funding purposes. The market responded positively to this announcement, with units of StarHill Global REIT rising $0.05 or 1% to close at $0.505 on Friday. This modest gain suggests investors view the refinancing as a positive step in managing the REIT's debt profile. For those who might be new to StarHill Global REIT, it's a Singapore-based real estate investment trust that owns retail and office properties in Singapore, Malaysia, Australia, China, and Japan. The REIT's portfolio includes prime retail properties such as Wisma Atria and Ngien City, partial interest on Singapore's famous Orchard Road shopping belt, as well as the StarHill Gallery in Kuala Lumpur, Malaysia. This refinancing move comes at a strategic time for the REIT, as it allows it to extend its debt maturity profile and potentially secure more favorable terms in the current interest rate environment. The sustainability-linked nature of the facilities also aligns with the growing emphasis on ESG, environmental, social, and governance factors in the real estate sector. The REIT sector in Singapore has faced challenges in recent years due to rising interest rates, which typically put pressure on REITs due to their high dividend payout requirements and reliance on debt financing for acquisitions. However, StarHill Global REIT's focus on prime retail assets in key Asian markets provides some resilience, particularly as retail footfall continues to recover post-pandemic. From a technical analysis perspective, StarHill Global REIT units have been trading in a range between 0.48 and 0.52 for several months. The current price of 0.505 is near the upper end of this range, suggesting potential resistance. However, the positive reaction to the refinancing news could provide momentum for a breakout if supported by increased trading volume. When comparing StarHill Global REIT to other retail-focused REITs in Singapore, its yield remains competitive, making it attractive for income-focused investors. The REIT's exposure to prime retail locations in multiple Asian markets also provides geographical diversification, which can help mitigate market-specific risks. In conclusion, today's Singapore Market Digest has covered a diverse range of companies across banking, aviation, electric vehicles, and real estate. UOB continues to demonstrate strong performance despite a slight reduction in CEO compensation. Singapore Airlines is strategically positioning itself through its partnership with ANA to strengthen its Japan roots. NIO faces ongoing challenges balancing growth with profitability in the competitive EV market. And StarHill Global REIT has taken proactive steps to optimize its debt profile through a significant refinancing arrangement. As always, these developments should be considered as part of a broader investment strategy, taking into account your personal financial goals and risk tolerance. I'm Iggy from the Investing Iguana, and I'll be back soon with more insights from the Singapore market. Thanks for tuning in to today's Market Digest.